This is a really complicated area. It's one that we often get asked about.
That's really up there in the top 10 questions, isn't it?
Do I have to withdraw all of my super when I retire? We get this a lot. Hi, welcome back to Super Insider, the podcast where we talk about all things super and retirement. And welcome back to those of you who listened to our last episode where we talked about our Retirement Essentials program and how you can plan, prepare, grow and thrive as you get towards retirement. What we're going to do today is, along with Ruth and Kane, welcome guys, thank you for joining me on the couch. We're going to be talking about the top questions that you actually ask us at these events. We've spoken to 45,000 of you over the last 12 months, but there's actually a handful of questions that we always get. Now, in answering those, though, please remember that today's podcast is of a general advice nature only. So please consider your own needs and circumstances and maybe jump on our website for more guidance or information, or speak to your own advisor or one of our advice team if you want further assistance. So, Kane, I might throw the first common question that we get from our audience to you. It's not a small one, mate, I'm sorry, but how much should I have when I retire?
Oh, that is I reckon that's the very top question. If I had $1 every time I got asked that, I would absolutely be retired myself right now. My answer to that is it depends, because it depends on what you want to do when your retirement happens. So what do you want to do? Do I want to travel overseas regularly? Do I want to move house? Have I got family and friends interstate overseas? Do I want to see them regularly, or is it my family all close? Do I want to eat out regularly at 5-star restaurants, or my local fish and chip shop is going to do it for me? So it's really getting that plan, working out what you want to do in retirement, and then that is where you go from there.
Ruth, when can I access my super? We get this a lot, and a lot of people hit us up with weird and wonderful ages. Give us the facts.
Of course, everybody wants to know this. We've been building up this superannuation balance for 30, sometimes 40 years. Of course, we want to know when we can get it and start enjoying it. And the answer really is, the technical answer is, you can access at preservation age. Now, to everybody else, that's essentially age 60. So depending on whether you're still working or not, if you are still working and you are age 60, you may be able to access some of your money through a transition to retirement scheme. Now, you will be limited on 10% of your money, but there is options there to start accessing through a transition to retirement. If you fully retired from the age of 60 or beyond, you will have full access to that superannuation. And if you're 65, you've got full access to it regardless of whether you're still working full-time or whether you've retired. So the journey or the shackles tend to come off the superannuation somewhat from the age of 60 onwards.
Kane, I'm going to catch you on the spot here. What about if you're not getting to retirement and thinking about accessing your money in retirement? Is your super locked away until preservation age, as Ruth described, or is there other things you can think about?
Well, generally with your super, it is locked away until you reach your preservation age, but there is different conditions where you may be able to access it through, financial hardship is probably the most common that we see. But super is obviously designed for your retirement, so there is strict rules around it, but you may be able to get at some of it.
Very well done being put on the spot. I'll stick with you though, Kane.
Sure.
Now, I'm sorry, you're going to get another very small question here. Can I get both the age pension as well as my super?
Really good question. And a lot of people think that they can't. And again, my answer would be it depends, because it does depend on what we call your assessable assets. So when you reach your age pension age, Centrelink are going to want to know what assets you've got, what income you're earning, and that'll include your superannuation, money in the bank, if you've got investment properties. They'll want to know all of that, and then they apply what we call an assets test and an income test, and they will determine whether you're entitled to any age pension as well. And I would encourage anyone, at least apply. even if it's a no, at least you've applied. And once a no doesn't always mean a no, because as you're retired and you start using those assets, spending and living off them, your assessable assets and income will reduce. So it might be, I hope that I've done that well at retirement. I can't get any age pension, but over time, and as I spend down my assets, I'm going to go back and reapply, and eventually I might get some age pension help.
And Ruth, we've talked about in a previous podcast that both of us have our retirement plan where we're actually having the expectation age pension won't be there at day one, and we're both proud of that. But can I ask, you've got an analogy or a saying that you say about the assets and income test. Can you just describe what you call that?
The means test? Is that the one you're talking about?
That's the one.
Yeah, to Kane's point, Centrelink will look at your situation, and if you're part of a couple, they will look at all of your assets as a couple, and they do apply those tests that Kane talked about, and it's called means test. And the reason we call it a means test is because they'll use the worst results for you.
They're rather mean about it.
But just picking up on Kane's point, it is important when if you're using the retirement calculators or anything, it does include age pension there. So if you've got an income that you're trying to generate, it's so important to remember that maybe your superannuation doesn't have to do all of the hard work. And age pension and superannuation can work beautifully hand in hand. And a lot of Australians access both at the same time. So they might have some age pension and are topping that up with regular withdrawals from super.
And we could even see that people have another key part of income coming into the mix, that they could have age pension at the same time as income coming from their super. At the same time, they could have employment income. And I think, to your point, Kane, you've got to understand or expect that they're going ebb and flow. There's going to be some years you might get more of one and not the other, or that opportunities will come that might give you income from a certain source or not from another. But if I can move on, Ruth, do I have to withdraw all of my super when I retire? We get this a lot.
Yeah, that's really up there in the top 10 questions, isn't it? The answer is simply no, you do not. There is literally no rule to say you have to withdraw your superannuation when you retire. If you've got a spouse or a partner at home who is still working or generating income and you've retired but you don't need your superannuation, you can leave it there. You don't have to tell the super fund the day you retire. There's literally nothing you have to do with that balance on retirement date. We want you to spend it. We want you to be able to enjoy your superannuation, but there are no rules around that. So the short answer is nope. You can leave it sitting there if that's what your heart desires. But I tell you what, I won't be leaving mine sitting there. I'll be spending mine.
So one of the things that worries our members or participants in our program a lot is they get concerned about tax. They get concerned about, and especially because there always seems to be this uncertainty about what the tax rules are. Kane, what is the tax treatment? What do people need to think about? And there's actually some good news when it comes to tax and retirement, isn't there?
Definitely, yeah. So we call 60 the magic age, because 60 is, as Ruth said earlier, it's your preservation age. So that's when I can get at my super if I meet the conditions of release. But when you're 60 or over, any money out of super is tax-free to you. So if I got to 60 and retired, I would have full access to my super. It would be tax-free to me. So whether I was drawing 50 grand a year out of it or 200 grand out of it a year, that is tax-free income to me. And when I turn it into a retirement income account, there is no tax on investment earnings. So every dollar that it earns, I get to keep. So very powerful tax advantage, and that's been deliberately done by the government to make it an attractive place to save and then an attractive vehicle to fund our retirement.
It's good to keep in context that these are really great concessions that are actually put on top of the tax concessions you get for putting money into it throughout your working life as well. So there is concessions that is applied as you accumulate, but really it's that reward for locking it away is that when you can get access to it, it has that tax advantage, isn't it?
Definitely.
Ruth, that tax advantage slips away probably, or could potentially slip away in one circumstance, and that's when it comes to when you pass away. This is a really complicated area. It's one that we often get asked about, but what happens to your super when you die? And can you try and just give a sense as to also that tax consideration.
First thing that's really important to remember is your superannuation is not automatically considered as an asset under your will. So we might have many listeners thinking, oh, that doesn't affect me, I've got a will. Well, your superannuation may not necessarily land into your estate automatically. You do need to tell your super fund who you would like that superannuation paid to. So if you think about your super fund, think about a fund like ART. We have 2.5 million members all around the country. We do not know everybody's personal circumstances and what they would like to happen to that money when they've passed away. Number one, it does go to somebody. No, the government does not take it. It doesn't sit in limbo. It will eventually be paid out to somebody. And you can control that very well by putting a beneficiary on your account. Or in other words, tell the super fund who you would like the money to be paid to in the event of your death. That is the first step to speeding it up for the people that you'd like the money to be paid to. Now, there can be different types of beneficiaries. There is what you call a binding beneficiary, which is the one you're really hoping that you can do. And that's a legally binding arrangement between yourself and the trustee of your fund that if I die, I want this person to get my superannuation. Now, you can't pick your cousin or your neighbour or your dog to receive your superannuation. There are rules around who you can nominate, and it's generally supposed to go to a dependent, so a spouse or a child or someone who's financially dependent on you. Or, to your first point there, you can also ask the super fund to pay it to your estate. So maybe you do have complex scenarios and you want certain conditions attached to how that money will be distributed. You may then need to send it to your estate. And when you're nominating a beneficiary, you'll see those options. You get to fill in the details of the person, or nominate your legal personal representative or your estate, in which case the money would be paid there and then picked up by the will and distributed as per your wishes. So number one, it doesn't get given to the government or sit somewhere. It will absolutely be paid out to somebody in your generally within who is classed as a dependent, and whereby one can't be found, it is probably then going to be sent to the estate.
And depending who it goes to and who it's paid to, Kane, there's different tax treatment there. So Ruth talked about it going to a dependent, and some of those will have tax-free payment of benefits, but some beneficiaries may actually have to pay tax. And this is something we often get asked about as well. Do you want to just very quickly touch on that?
So what a lot of people don't know is your super is made up of two components, tax-free and taxable. And without getting into the weeds, most people's super is taxable because it comes from your employer contributions. For you, the super owner, doesn't really matter, because the minute you're 60 or over, you're getting it tax-free. Doesn't matter what the components are. But for people who inherit your super, then those components do really matter. They'll inherit the tax-free component tax-free, but the taxable component will attract, more than likely will attract some tax for those people. So that can be a consideration in some people's estate planning, where I can do something about that ahead of time. Is it important to me? Do I want to do something about it?
And probably the most important group there is if you're wanting that inheritance from your super to go to an adult child, then there will usually be some tax implication. Yeah.
I think that the most common question that we've seen throughout the programme is around spouses generally, so spouse or partners. And it is important to remind everyone that if it is your spouse or partner that is your beneficiary, they will receive it all tax-free, as will a child under the age of 18 or anyone who can be classed as a financial dependent. So to Kane's point, the tax consideration generally is for older children as opposed to those financially dependent individuals, including a spouse or a partner. So it is a complex area for sure.
And much of what we have actually covered off is complex. They're the most common questions that I think about that we get asked. Are there any others that you think we come across a lot?
There's actually one that we're getting a lot, obviously, in this environment, the financial climate. We've got the budget changes, and one that we get asked a lot, and I would actually like to put you on the hot seat. You've been grilling Ruth and I.
Fair enough.
So a common one we get asked around super, like, how's my super fund doing? Should I manage my investments myself? Self-managed super funds. Love to hear your thoughts and how you would answer that. Should I manage my investments myself?
I think a lot of people think about self-managed super as somehow they're going to perform better with it or that it gives opportunities. There's a couple of things that I'd probably suggest. Self-managed super is really great for the right person, but it's also really great when you know what you're wanting to use it for. So are you wanting to use it for a specific estate planning purpose, a specific investment purpose? If you're thinking you could just do it better, I'd probably cause you to pause a bit. And the things I'd get you to think about is, well, actually look at how your super fund's performing. Do you think you could actually, over a long term, through another way, achieve better than that? The other thing to think about is looking at how much your super fund is charging. Self-managed super funds can be expensive, especially if you've got lower balances. So there is a way up that you've got to take there. I think it's also really important to think about, well, how am I going to invest it? With a fund like Australian Retirement Trust, you know you can invest in most things you probably would want to through your self-managed super fund. We invest in shares, we invest in property, we invest in things that you couldn't access, infrastructure, private capital. So it's important to maybe weigh up, well, am I not getting access to something I want? And the other thing is about the diversification of that. Self-managed super funds, again, depending on the balance and depending what you're wanting to do in terms of investments, such as if you want to throw it all into a property, there's a concentrated risk there. All your money's in one spot. And particularly as we talk to people about approaching retirement, you can't just sell part of the house. And there's also tight rules there. The last thing I'd go to, and Kane, you probably knew that asking me a short question, you get a long answer. But the other thing that I'd go to is when you come to retirement, you're probably wanting to wind down your responsibilities. Do you want to think about running a fund that needs to have accounts done? You need to consider your responsibilities as a trustee. You need to manage it. You need to invest it. And for some people, it might just be, look, my retirement plan is actually to hand that over to someone else. What we tend to see at a lot of our events is actually people who have a self-managed super fund who are coming to suss us out and say, well, actually, I want to hand that responsibility over to someone else. So it's a great tool and a great product for the right people and at the right time. I would probably question, whether retirement is the time you'd want to lean into it. But that gives us a wrap on the top questions. Nothing else you can think about? Is there anything weird and wonderful that we ever get asked or that you've come across that you've gone, that's a doozy, actually?
I think we get a weird and wonderful question at every single session that we do. So it's hard to sort of summarise them. I think I would challenge everybody to, what's your weird and wonderful question? Everyone should have one. That question, could I ask this? Should I ask this? Everyone should have one of those.
So thank you for your time. Thank you to those of you who have helped us shape these questions. And to those of you who haven't yet been to an event, we hope to see you either online or in person in the months to come. Remember, though, to jump on to our website, listen to our other podcasts, register for an event, and do subscribe to this podcast. Our next one is going to be an end-of-year investment wrap-up. So a great way for you to see how your super has performed for you over the last 12 months. On that note, take care. We'll see you soon.